Good morning, I'm Richard Higgs from Harold Stevens. We are financial planning specialists for people in later life and retirement. And today on this freezing cold January morning, I thought it'd be good to take you through some of the investment outlook for 2024. This will be of interest to perhaps people with investments, interested in pensions, maybe thinking about investing money. Also, if you're not interested, perhaps where to go, what to look for. Before I start, let's go through a quick recap of what happened in 2023. It was a year of lots of headwinds, challenges, issues around the world. I'm sure you're aware of. Inflation being really high and interest rates rising. We had geopolitical tensions, we had wars, we had the cost of living crisis. So it was a year of, tumultuous year really, of challenge in the world economy. But despite that, actually the stock markets finished in positive territory, which was quite an achievement. The one caveat to that is that it was really the US market that dragged everybody else up, and specifically the Magnificent Seven, the so-called Magnificent Seven, the mega tech companies, Google, Facebook, Amazon, really specifically massively outperformed the stock markets around the world and also in America. So that kind of dragged up the overall global returns for 2023. In terms of continental Europe, there was a lot of challenges in 2023, but inflation actually came down quite dramatically, down to 2.9% on the continent, and that did help with a last gasp stock market surge in Europe, which helped things in European investments. In terms of emerging markets and Asia, China continued to struggle. The property market imploded. We had the passing of property companies. We had really low customer sentiment, client sentiment, and that really had the knock-on effect of affecting the rest of the Asian region. So emerging markets continue to struggle, and really towards the end of the year there was some degree of optimism. It looked like interest rates may have peaked now. The market's factoring in a 1% cut now into 2024. So I would certainly, by the end of 2023, my overriding recommendation would be to stay invested, because if we do see some interest rate cuts in 2024, we might see some individual specific stock market surges if we see the light at the end of the tunnel, as it were. So let's move on to 2024 and our outlook for 2024. I'm going to take you through a bit of an analogy, a medical analogy, where the illness is inflation, the medication is interest rates, and the side effects of that medication is the effect on the economy, whether that's the economy growing or stagnating or indeed going into recession. Now, using this analogy, since 2021, we've all been pretty ill, really. We've had high inflation, which originally was thought was on the back of COVID and people spending a lot more after the lockdowns. But that's became a longer term phenomenon. And so it meant that we had to start prescribing medication to help with that illness of inflation. And that medication has been rising interest rates. Now, rising interest rates to combat inflation isn't felt immediately. So we've been monitoring things since 2021 to see what the side effects might be and whether we can actually cure this illness. Excuse me. So as we go into 2024, there's really three possible scenarios in 2024 that could play out, really. The first scenario is that the medication is working. So the medication that we're providing to help with the illness, the rising interest rates to help with inflation is working, but the side effects are a lot more severe than we currently anticipate. And that would play out in the economy going down, probably into recession. If that plays out, it would mean that that would put pressure on the stock market, put pressure on the economy, and it's likely that your stocks and shares will go down in 2024. Excuse me. The second scenario would be that the medication is gradually starting to work, and that's actually having a good effect on the illness. So inflation is starting to come down, and actually there's limited side effects. So the economy is still working, still being resilient, and in that scenario it would mean that we might be able to start coming off the medication gradually in the form of interest rate cuts. If that scenario plays out, it would mean that the stock market would probably rise in 2024. The final scenario is pretty much the most unlikely scenario, is that if the medication isn't working and we're just not getting on top of inflation despite increasing interest rates, and we have some severe side effects and the economy goes into recession. So if that happens, obviously the stock market will go down, but I feel that the main likely scenario is something between scenario 1 and 2, where we are continuing to use the medication. It's starting to work. We're starting to see inflation come down, but we're also seeing some gradual increase in side effects. So it's still a kind of wait and see really for 2024 to see how that medication is working and to see what kind of side effects there might be in 2024. Let's look a little bit more about specific markets within the world and the outlook in 2024. UK, let's start with the UK. UK has been really unloved really by investors over the last few years. But that does mean that we're seeing bargain basement prices now in the UK, especially smaller UK companies, medium-sized. Really the domestic market has been hit really hard, and it looks like probably all the bad news has been factored into those prices. So I would definitely recommend UK as a potential bargain place to invest at the moment. There are still some things to play out. For instance, interest rates. I don't think interest rate rises have fully impacted upon households yet. There's about 4 million mortgages up for renewal in 2024, so we'll see how that plays out. And the other thing is inflation. Although it's come down from 10.5% down to 3.9%, which is a big jump, I think the Bank of England are going to find it a lot harder to get from 3.9% down to 2% by the end of 2024. So we have to keep a watching eye on that. But definitely an interesting area, the UK, in terms of bargain prices and low prices. If you want to get in there, invest at low prices. US, American markets, really it's between two markets, split between two markets. We've got the Magnificent Seven on one hand, all the mega tech companies which have done absolutely amazingly, outperformed both domestically in America and also globally. If the economy does start to go into a downturn or even a recession, it will become really hard for those companies to justify their high share prices. So that is something to watch for if that kind of scenario happens. And the rest of the American market actually hasn't done that brilliantly the last few years. So we are looking at potentially low share prices, investment prices in the rest of America. What I would say is in the bigger picture terms, American market at the moment is absolute peak in relative terms to the whole global market. So if we do start to see some interest rate cuts and the economy starting to look a bit more optimistic, it might be that it's the opportunity for the rest of the world to kind of catch up with the share prices. So the opportunities may be better outside of the USA in 2024. And finally, what about China and the emerging markets and Asia? Well, as I said, China have had some really difficult problems over the last few years, but there are signs of optimism. China are looking to invest $112 billion in infrastructure, property support for property companies. They're looking to try and influence banks to reduce mortgage rates for borrowers. And maybe there's some reducing intentions between America and China. We'll have to see what happens. We've got an American election coming up this year, but if we see any signs that those tensions are starting to ease, that'd be really helpful for China, and then that will fall through to the emerging markets and Asian region as a whole. So also in terms of the long term, the general consensus is that China, emerging markets are going to perform or significantly outperform developed markets over the long term. It really just depends this year first of all, whether China's measures to prop up the property company, which is such an important part of wealth for Chinese households, whether that's successful or not, whether they follow through with it, and also whether those tensions between China and US kind of ease further or worsen. So that's kind of just where we are at with China and the emerging markets. So that is a brief run through of what I'm thinking, where we're at with the economy, where we're at with investments. I would strongly recommend, probably the conclusion is that different things can play out, different parts of the world can have different impacts and different, I suppose, react differently to the medication, the interest rates medication. And so it's really important that you have an investment manager, someone that's managing your pensions and your investments, that's looking at things on a very regular basis in order to capture any opportunities that arise through the year. So, and also to be really well diversified, because things can change, different parts of the world can react differently. There's different asset classes that you can invest in to reduce the ups and downs of your investments and pensions. So lots to be kind of looked at. With us, you can pop in and have an initial chat to look at your personal circumstances and to make sure that your investments and pensions are working towards your own specific financial goals. It's important to note that we're completely independent, so we're allowed to research and recommend the very best portfolio managers and investment managers, the ones with the best track record, giving you the best returns at the lowest possible risk. So we're delighted to see you. I hope that's been useful or interesting for people that have investments or are thinking about investing. All the best for 2024, and we'll see you next time. Thank you. Bye.